Hello, everyone. Good morning, and thank you for joining today's webinar. My name is Mirza. I'll be your host and presenter for this morning's session on digital disruption facing the Canadian banking scene. We do welcome your feedback. This will be quite an interesting webinar. Joined with me today are Hwan Kim. He is an experienced management consultant with Monitor Deloitte. He has a broad range of experience in helping financial institutions develop and execute growth and innovation strategies. Hwan was the project lead on the World Economic Forum's research for the future of financial services, developed in collaboration with Deloitte. So he has quite a wealth of experience on fintech and the future of banking. As well, we're also joined by David Bradshaw. He is the Vice President of Client Business Support, leading the entire client processing for all lines of business. Prior to his current role, David was the Vice President of Sales and Service for ING Direct Canada. And David is also the Treasurer and Board Member for Raising the Roof, the charitable foundation. We're also joined by Paul Frank. He is the VP of Sales and GM with DMTI Spatial. Paul leads the vision, strategy, and execution for DMTI sales and client operations. DMTI's goal is to help companies of all sizes unlock the value of location intelligence and better achieve their organizational goals. So without any further delay, we're going to pass the presenter rights over to Hwan. Hwan, please, at any moment, feel free to start your presentation.
Thank you, Mirza. Hi, everyone. Great to speak with you guys today. I lead our firm's the Future of Financial Services initiative globally, and we look at all these emerging innovations and disruptive new entrants, and think about how those innovations will actually change the future of the future landscape of the financial services. So today's presentation will focus on kind of how these emerging innovations will reshape the future of banking. We'll go through quickly some of our findings from our research with the World Economic Forum on disruptive innovation in financial services. And then we'll quickly move into looking ahead and speak about how those innovations actually may come together and reshape the ways the financial services or the banking is structured, provisioned, and consumed in the future. So over the past 2 years, we've been partnering with the World Economic Forum to launch a project in response to the demands from the global financial institution CEOs on how all these emerging innovations, so fintech's a hot topic in many countries right now, but not looking at which fintechs are interesting or cool, but really going deeper into how these innovations are actually going to impact the ways in which financial services are consumed in the future. We led a pretty collaborative research with the World Economic Forum. We engaged over 40 CEOs and C-suite executives, CEOs and C-suite executives from over 40 global financial institutions, ranging from Deutsche Bank to Visa to different companies. And as well, we also brought together CEOs and founders of over 100 innovative companies in financial services. So whether they're small starting fintechs or large established fintechs been around for 7 to 8 years now, we brought those very different groups together. And what was really unique about this research was we actually brought them into the same room. So the outcome of this research was based on that debates and discussions within the groups, so the traditional bankers, as well as the next generation of financial services providers. So we hope this brings a wholesome story around in navigating how the banking industry may evolve in the future. So the outcome of this research was kind of the first consolidated taxonomy of disruptive innovation in financial services, so outlining which of the innovations are actually the most impactful to the core functions of financial services, but more importantly, delving deeper into how a different range of scenarios may be played out as a result of those innovations being developed in the market. And we looked into, what does that mean for the customers and financial institutions, as well as the financial services ecosystem. And what we basically then were able to synthesize were some of the unique insights about innovations in financial services. So in contrary to what most people believe around kind of the random nature of innovation, what we found with about the innovation in financial services was that they were actually quite deliberate and predictable. We saw that most of the innovations are actually the manifestation of the areas where the customers are frustrated or experiencing friction today, and at the same time, the largest kind of profit pools exist today within the traditional financial institutions. So, whether you look at, marketplace lending, a lot of those marketplace lending products actually emerging across areas where the customers are actually having challenges getting served by the financial institutions. Or when you look at peer-to-peer money transfer that are proliferating at other markets, or remittance solutions, a lot of those things actually exist or emerging because customers are experiencing the greatest level of friction. And applying the same logic, it also would be applicable to start to think about where innovation is going to continue to emerge in the future. It is going to be the areas where customers or financial institutions are experiencing the most amount of pain points today. At the same time, we found financial institutions to actually employ quite unique strategies. So they actually employ strategies where they're quite product focused. So they focus on specific products and with very specific value proposition, and they attack or play a role within a very specific part of the overall banking or financial services landscape. So because of this modular kind of focus structure, they leverage kind of platform-based, data-intensive, and capital-light models. So what we see with a lot of innovations in financial services today, the ones that are successful, they do not try to replicate the entire banking model. They try to go in and tackle very specific areas where they can really excel in, and they be great at it. And finally, we also see a lot of imminent impacts of disruption, within the banking sector across financial services. But there are other sectors like insurance and a couple others that we'll also see the level of disruption in the future as the basis of their the products are changing.
So Hwan, before we get into some of the more actual digital disruptors, let me put it over to David. David, what did you see, being that we've almost deputized you as being the Canadian banking champion here? I know it's a tall order, believe me, but what are some of your insights that you can share on this webinar for those that are, that have come in from the banking space? They're obviously looking for maybe some guidance, maybe some insight, anything you can share. After all, you're almost like one big family, right? So before we get into the nitty-gritty of the actual disruption, what can you point to? Is there maybe two things that you can point to right now?
I can, and please don't put that type of responsibility on my shoulders.
Fair enough.
So the biggest thing that we see is really looking at the customer experience. So what we're seeing is that in terms of disruption, is that customers get other experiences from other players and non-banking players, so your Amazons, your Zappos. So they get these great enriched customer experiences where the organization has a view of that customer and understands that customer. So where I see banking going and where I see what's happening even within Tangerine is that we see the differences is truly focusing on the client experience and making that client experience seamless and truly really understanding the customer's needs and the customer's wants and using data to do that.
Right. Good point. Good point. Hwan, do you want to maybe continue then? Do you have any feedback on that?
No, I think that's absolutely right. And if I think about, as we kind of looked into why these innovations are actually happening in financial services, I think what David just put around that rising customer expectations, and in today's day and age, really set by non-financial institutions, I think that's one of definitely the key drivers of why we're seeing the influx of innovators in the market today.
Well, just to add to that, what we're hearing a lot is there's clearly a lot of investment within the market towards transformational initiatives around customer experience, omni-channel being a key one, intelligently automated transactions around next best action capabilities, I'll mention, highlighted earlier that, Gardner says by 2018, 80% of all customer interactions with an online brand will be automated, and we'd argue intelligently automated. So you're seeing huge trends towards that movement within this space.
Right. Okay. Interesting. Hwan, do you want me to forward this to the next slide?
Yes, please.
Okay.
Right. So, and then when we look at how incumbent institutions are actually reacting to these innovators or this, level of disruption, what we actually found was quite interesting, especially when you look at some of the large global players, what those large global players are doing. So, in effect, they're really taking parallel strategies. So, on one side, they aggressively compete with the new entrants offerings in their area, in the products and the part of the value chain that these disruptors tackle. But on the other side, the very same incumbent players also, act as partners or the overseer to some of these innovators by leveraging their legacy assets to provide these innovators with infrastructure and access to, whether that's capital or information and as such. One of the greatest examples in here would be what's happening in the robo-advisor space. So, one of the largest and the oldest robo-advisor, Wealthfront, they are, in a very direct competition with, players like the traditional players, in where they're eroding margins away from specific types of products. So we see that, a large asset manager, Vanguard, actually launched their own robo-advisor solution about a year after Wealthfront entered the market. So we actually see that like a very fierce competition around with the same business model between large and small players, the traditional and new players. But at the same time, Vanguard also is an exclusive provider of the ETFs that are actually being sold through Wealthfront. So there's that very deep level of collaboration that's also happening at the same time. So increasingly, we're going to see more and more this level of collaborative competition within the financial services ecosystem going forward. And this collaboration is also very important across kind of regulators, incumbents, and new entrants to really, deeply understand how these innovations are actually going to change the risk profile of the overall industry, some positively and some negatively. When you look at a lot of these different business models, because they're untested and a lot of them actually disintermediate the role of traditional intermediaries like banks, they actually can create new risks that have not been experienced by the industry and sometimes are unforeseen and than what would have been expected. So as a result, this level of conversation becomes increasingly important. In more developed markets like UK or Australia or in the US, we're definitely seeing more and more of this level of collaborative dialogues going on, led by kind of the regulators and then between incumbents and new entrants. I think the same type of movement is definitely going to kind of come into Canada, and that'll be definitely a key inflection point where we'll see more and more innovation in financial innovation within Canada. And finally, a lot of this innovation and disruption is not a one-time event. So when we speak with our clients and the banking executives, and sometimes we used to hear expressions like, innovation is our 2016 top priority or 2017 agenda. But when you actually start thinking about how these innovations or disruptions are really making an impact to the industry, they actually, they're not there to actually go in and directly compete with the bank or try to become a bank, but rather they actually create this continuous pressure because they're in collection, they're actually shaping financial consumers' behaviors. They present new business models and profit models, and they alter the competitive dynamics within the industry. So as a result, all these different pressures that are emerging as a result of the innovation and disruption is a continuous one. As a result, financial institutions need to start think about how to respond to these on an ongoing basis, and a more strategic level, rather than one-off kind of project basis response.
Great, Hwan. Do you want me to forward now to slide 9? Do you want to get into the heart of some of what will happen with in terms of a banking model? How
sounds
it's
great.
become unbundled, which is really interesting.
Yeah, and this is basically our view on, it's good to have that last point we talked about, how all these innovators are actually going to come together and actually create the continuous pressure to the financial services industry. So the first kind of the prediction we're having is around the unbundling of universal banking model. So by universal banking model, we mean if you think about the financial services today, in most cases, consumers choose their financial institutions either when they get their first allowances when they're kids, they go to their parents' financial institution and open an account, or they open an account because it was nearby their university or their high school, or they open accounts when they get a new job or get employed for the first time. And traditionally, financial institutions have made money off that initial customer acquisition, and that acquisition used to drive a very long tail kind of revenue across the customer's life cycle. So a single institution or the primary institution being able to cater to 70 to 90% of individuals' financial services needs entirely. But what we're seeing with a lot of these innovators, though, it's because they're actually coming in with very specific value propositions, but as well as with very specific, and they target very specific products and services in isolation. They actually start creating this very, specific margin pressures against traditional banks' individual products and services. At the same time, because they're so product focused, they actually are, as they gain customers' trust more and more, they're conditioning customers to shop financial services in a more, best of breed and product by product basis. So instead of, going to your primary institution, they're increasingly looking at, customers are increasingly shopping one product over another product. I think this is already quite of a popular trend that we were observing in some of the other markets like US or UK, where products like insurance or credit cards or mortgages are actually being shopped on a more of a product by product basis. So they actually do not go to their primary bank by de facto to get their financial services needs fulfilled. And I think this trend will also be amplified as kind of some of the non-traditional technology players with customers' trust enter the market and start creating digital marketplaces. So recognizing that Google did exit the market last year on the insurance side, but we're actually seeing quite a bit of these type of digital aggregator or marketplace models being emerging from the likes of like the Amazon and eBay type of players in certain markets like Australia and New Zealand, or the evolution of insurance aggregators like Money Supermarket and a couple others in the UK, evolving above and beyond in insurance and into every single financial products that are actually being offered by retail banks. So when you look at those providers in UK, they actually do allow customers to do price shop, do comparison shop for products like credit cards, line of credit, short-term loans, auto loans, deposit accounts, and as such. So as a result, when these kind of different forces all come together, we'll see increasingly more kind of product-based competition, and this raises a big question for financial institutions around then which part of the value chain that they're actually going to focus on going forward. On one side, for the institutions that are choosing to be, customer-oriented, now the new bars and standards are going to be set by the likes of the Googles and Facebooks and Amazons and Apples. So, the new bars of competition will all of a sudden be not your next door competitor, but be these global leading non-financial institutions. On the other side, for the financial institutions that choose to kind of play more on the product side and compete as a manufacturer of products, now they're actually going to compete against the whole flux of institutional and non-traditional players that are entering the market with sophisticated capabilities to specialize in product manufacturing. So I think a great example of that would be Goldman Sachs here announcing to enter direct-to-consumer lending business. So as you see more and more of these kind of ecosystem disaggregation of the financial services value chain by the ecosystem, this will basically raise a very existential question around what banks will aspire to be in the next 5 to 10 years.
So Hwan, David, if the banks themselves are, if they're facing a threat from these very niche players which are taking on components of banking experience, and then on top of that, you have these non-traditional tech players like Apple, like Amazon, could it be only then a matter of time whereby you'll see maybe an Apple Pay bank. David, is that a concern amongst your peers within the banking space right about now? I mean, everything, we're all so tied to the hip with our cell phones. It could be easy enough that we just get on our iPhone and bank that way.
Yeah, it's we do see the threat, but it's not imminent yet. And the main reason for it, if I went back to a couple of Hwan's slides, is really around the regulators. We're heavily regulated in Canada, and one of the things that the regulators are struggling with is that these niche players are not traditional banks, so they don't follow the same regulations as the traditional banks have. And to be honest with you, the government, which is primarily the regulators, they're a few steps behind the new entrants. So the government or the regulators need to catch up with the technology, and they haven't caught up yet. So that's a struggle.
Well, it's an interesting, and so by way of context, I had lunch with basically a gentleman who runs customer experience for one of the top 3 banks, and we were talking about that. And I asked him, I said, where do you see your biggest competition? He said, I see my biggest competition coming down the road between Google and Facebook. Money, to your point, even though we're regulated in Canada, is easily transferable out of the country through these components as well. And so he basically touched on all the trends we talked about unbundling. And I asked him, how do you plan to respond? He goes, well, the real key that people need to understand is the unbundling is a means, but where's the end? Google and Facebook, for example, won't help people retire, as an example. So they need to focus on a larger overall financial insurance policy to help with that, knowing that there's the retailization of the market. You know, we're seeing that as well with Walmart, even coming into the market. You see President's Choice, for example, doing that in this type of market. So there's a number of elements that are driving towards on the low end, but where it was the end goal, where they're trying to help migrate the entire wealth cycle of a client, for example. And
that's a very, very important point, Paul, because one of the things that we're looking at is we're looking at our customers and their life cycles. So, so we're saying, okay, so customers are at different stages in their point. So newer people are in the accumulation stage. So, the younger people are in the accumulation, they're in the spending stage. So what does their financial picture look like, and what are the tools and products and services we can help them with? Then you have people that are in the growth stage. So, the people that are more established in the marketplace and have more disposable income, they tend to be bigger savers and investing for the future. So how do you deal with those people, and what are the tools do you have for those people? And then you have the people that are in the income, they want to grow income and get ready for retirement. And then you have people in the deaccumulation stage, right? So how do you make sure, and that's a great point that Paul made, like how do you make sure that you're able to look at the customer's life cycle and offer products and services? The debundling, to me, is more of a trigger in terms of they're a friction point in the marketplace. And some financial institutions are underserving specific markets with some of their products and services. And these niche players have seen this as an opportunity. Let me get in there and let me offer them a mortgage that's really, really simple and hassle-free.
Right. Okay. Thank you, Paul. Thank you, David, for that great feedback. Hwan, do you now want me to jump to the next slide?
Sure, sounds great.
Okay, done.
Right. So the next one's around kind of on the investment side, that banks' deposit may actually be reduced in the future. So the banks have this traditional kind of term structuring and the leverage role play that in kind of making the loans and the deposits connect. But what we're seeing is increasingly customers are actually getting more and more empowered, especially in the kind of the lower interest rate environment. They're looking for new ways to utilize their money. And now they're actually getting provided with new options with very lower thresholds. So they get access to these type of new ways of investing money, as well as new asset classes that are previously restrictive to kind of the higher end or institutional players. So whether that's talking about the proliferation of passive investing models and being offered through robo-advisors with very low minimum thresholds, or whether that's actually about marketplace lending platforms enabling consumers to directly pick and choose the risk level they're willing to take on, or whether that's talking about the crowdfunding models, crowdfunding platforms that are enabling customers to participate in an equity and debt capital raising. Now, when you actually look at all those different players, they will create kind of the pressure on the retail bank's core deposits. So what we're not saying is customers are going to entirely move their deposits away or money away from deposit products and into these new investment vehicles. But increasingly, more and more customers are going to have higher expectations around how they want to utilize their money. So as a result, they may actually keep lower amount of money into their deposits account, and as a result, banks may in the future kind of lose that benefit of scale on kind of lending and investment activities, which will further kind of reduce their ability to provide a more appealing kind of deposits and investment products in the future. So this whole kind of cycle of what will happen as consumers start utilizing money more and more smartly.
So if the bank's deposit balance is also going to be reduced at the end of the day, you have these smaller niche players looking after smaller components. This is a wild idea, I'll just throw it out there, but does it maybe even make sense for banks to become smaller themselves and focus on small parts of the puzzle, or does it make sense for banks to stay big and focus on the...
Do they create offshoots? Like we're seeing insurance and financial companies invest in fintech, knowing that'll cannibalize the service, but they'll own it. I mean, Scotia did that. They bought ING and Tangerine.
Yeah.
Separate channel altogether.
Good example. Okay.
Exactly.
Okay. Good example, Paul.
Exactly. And the pressure on the banks in terms of the deposits is not. It is the niche players, but the niche players also saw the opportunity because they saw blood in the street with low interest rates. So we're in a low interest rate environment, and banks still need deposits for two reasons. One, they need it for capitalization, so they have to be well capitalized under the eyes of the regulator. And two, they need deposits so that they can loan money. So banks have to find a way on how they can bring deposits into the bank and yet still be able to provide a return on capital. And part of that's going to be they're going to have to streamline their business. They're going to have to eliminate waste. They're going to have to automate processes. They're going to have to deliver their products and services and distribute them in a more effective and efficient way in order to ensure that they have the return on their investments. But banks still today and will always need retail deposits to fund their lending businesses.
The other thing I'd say is a lot of this disruption, you can see it just, for example, in Waterloo and the amount of startups in that space and how much of the big players in FinServe are sponsoring and investing in that market. But it's not just to cannibalize the market, some are enabling it. So more and more you're seeing connected ecosystems, for example, between deposits and, for example, mortgages, for example, extended ecosystems. How do you facilitate more of that ecosystem to make the more incumbents who have the customer today, but the legacy relationships to be more nimble in that environment? So you're seeing a facet on both sides.
And that's a really good point. So I see the banks join in with the fintechs rather than fighting with them. I see them doing, partnering with them. You're going to see more partnerships with the fintechs, to Paul's point, rather than competing with them.
Okay. All right. So Hwan, do you want us to head over to the next slide?
Sounds good. And this one's looking at on the other side of that puzzle around lending, right? So especially around that traditional mechanisms of measuring customers' risk profiles. So the traditional average-based scoring system of the banks, and we may actually see, those models kind of losing their efficacy over to type of the new models and data feeds that are emerging in the market space. So on one side, increasingly, a lot of these cashless payments providers, so whether it's mobile wallets or those on-phone purchases for things like Starbucks now, where you can order ahead and then actually process your payments through online. Well, one of the trends we're seeing there is a lot of those players increasingly allow consumers to actually fund those transactions without using credit cards. So, if you think about some of the key roles that credit cards played, I think it, among kind of the facilitation of payments, among providing the line of credit and providing kind of loyalty, I think that leg around, facilitation of payments is more and more being replaced by some of the cashless payments providers. And as a result, we may actually see kind of the reduction of kind of usage in kind of credit card type of the credit card loans, and which is arguably one of the key drivers in terms of individual, one of the key dynamic drivers of individuals' credit history today. So around how credit scores are measured today. On the other side, as we see a little more unbundling of consumers' financial services, financial portfolio, as we see this dispersion across multiple providers, the individual financial institutions' ability to get a full view into holistic financial background, health, and the condition of individual customers may be limited. So if you look at how a lot of traditional institutions adjudicate or assess credit scores today, it'll be in conjunction with the traditional or the credit scores that are available out there, like Equifax and as such. But you combine that with some of the historical financial data that banks have today to assess customers' risk profiles. But when that historical data set becomes less and less relevant or accurate, as it may not represent the full view of customers' financial conditions. These traditional kind of models of average-based scoring models may lose efficacy. On the other side, what we're also seeing with some of these new entrants, so especially around some of the marketplace lenders or balance sheet lenders, when we actually talk to their companies and their CEOs, they actually do not think that peer-to-peer or the marketplace-based model of their businesses are the key differentiators. Where they actually see the key differentiator of their business is actually around their alternative adjudication models. So being able to actually leverage, because they are product-based and because they do not have the depth of customer information that banks have, they tend to rely on these new types of data sources. So whether that's about social data feeds, people looking at how many times a person makes postings on their Facebooks, post 3 a.m. on a work date as a measure to understand how creditworthy or trustworthy that person is. We're looking at some of the contextual or behavioral data sets. Some of the providers looking at what are the websites they visited before coming into their website as an indicator of the risk level. So as you see these type of new contextual and behavioral data sources helping new players improve the accuracy of their risk assessment, this may lead to adverse selection against the traditional risk average-based models that banks use. So I think a good example of this is when you go look at a lot of these marketplace lenders' risk classification, they use from anywhere from 10 to 30 different risk classes to classify their customers into. So they're kind of moving towards, if you think about the insurance example, in insurance, a lot of insurers are moving towards kind of that more customized and individualized pricing model. I think we're definitely seeing more and more of those movements driven by some of these new entrants in the lending space. So, as those models get more proliferated, how much of adverse selection, will be experienced by the traditional banks, I think remains a big question in the future.
So in terms of data, what are some of the other Canadian banks doing? Or maybe if you could mention at a high level, what is Tangerine doing to really understand the customer from a data point of view?
Yeah, it's so just a point of clarification. The bigger banks, due to acquisition, due to legacy systems, don't have that 360-degree view. Because you could, so for example, I could be a credit card customer and applied for credit, and they would use a very myopic view, which is the traditional credit scoring method, to score me. But they're only looking at me from a credit view. What they haven't looked at is I have mutual funds of over $100,000. I have a deposit balance of $50,000. Oh, but my credit score, I made a late payment on my Rogers bill, so I get declined. But they haven't taken a look at the overall relationship of that I have with the bank, because the systems don't talk to one another. And that's a problem in itself.
Yeah, and similarly, what we're hearing is around the banks don't have an issue collecting the data. It's siloed, to your point. And how do you provide insight, particularly in real time at the point of interaction, however the customer is working with your brand, whether that's at a retail whether that's online or in a call center, et cetera. And they're investing significant dollars in terms of BI and analytics. But then again, the challenge is, how do I unlock this system or the data from legacy systems? It doesn't even match up internally. So that's a fundamental challenge they have.
Right. And if you look at people, the new entrants, they don't have 150 or 185 years of legacy systems. So you look at someone like even like a Facebook, right? So Facebook has all this data and all this information to the point that they've been able to monetize that, right?
Right.
So it's very easy for them to enter into this space and have all this richness in terms of, you know, what their customers look like and what the customers need. We're not there yet at Tangerine, although we're only 17 years old. We're making progress, but we're not there yet. We still have some work to do in terms of really getting that complete view of our customer.
There you go. Something to be said about having a complete 360-degree view of your customer. Hwan, would you want me to progress now to the next slide?
Yes.
Perfect. There you go.
So the other thing to also think about is the changing kind of the needs and the demands of consumers, more on how they actually make and spend money. So as kind of the sharing economy platforms kind of proliferate, it kind of is fundamentally changing the definition of employment and self-employment, creating kind of new ways for consumers, traditional consumers, to participate in production activities. So as a result, you know, we'll see more individuals actually have, you know, more than one single source of income or more than single traditional sources of income. So I think we're already seeing this in markets like Asia, where the population is aging a little quicker. We're definitely seeing a lot of movement towards consumers, instead of having, you know, one job, you know, with paycheck coming in every 2 weeks, having, you know, a job that may have, you know, fluctuating payments that come in depending on the level of work they engage to do, as well as in addition to those kind of more traditional income sources. So as a result, a lot of these kind of, you know, traditional models of measuring and managing individuals' financial health and conditions may become less reliable in the world of this non-traditional source of income. On the other side, the way the consumers are also consuming or spending money is also changing, right? So especially within the urban population, we're increasingly seeing the concept of property ownership disappearing more and more, whether that's with the homes or the cars and as such. And as the ownership-based economy kind of turns into more of usage-based economy, kind of this will also challenge the traditional asset-based, you know, measurement and creditworthiness of riskiness, but as well as the way the financial products are structured today, especially on the lending side, because a lot of times they're structured against the big purchases or ownership decisions. So as a result, kind of today's model of serving retail and SME customers will be not sufficiently cover future customers' needs, as the customers' both source of income and their consumption patterns diversify in the future.
So in terms of a question from the audience then, this is open to all three of you, Hwan, David, Paul. I mean, I guess it was just a matter of time, but Uber. So will there ever be, or is there a possibility of having an Uber-like bank, you know, almost credit union-like, but, you know, everything is just at the touch of an app? If we are going to be basically getting more and more access as individuals to non-traditional sources of income, hey, why don't we just share a big pot of money, like a microfinance? Does that even make sense? Will we ever see an Uber model for banking, or is that just, you know, a pipe dream?
That's an interesting question. I think just in talking to different generations, in talking to different customers, and talking to different generations, I don't see that happening. I see it somehow. It's a continuum in terms of technology and how we leverage technology. At the end of the day, you're dealing with money, and money is a very personal thing with people. And there's still going to be a need. May not be as a bigger need, but there's still going to be a need for contact centers. There's still going to be a need for customers to talk to someone, because you're dealing with money. So I think if we dehumanize the whole banking industry, that's going to be a big problem, because people are not going to be able to have access to talk to people. So You know, when we look at people like Amazon or even Zappos just selling shoes, right? So you go online, you compare the shoes, and you go, okay, I'm going to buy those pair of shoes.
Right.
You know, you're spending $30, $40 when you're dealing with a mortgage or you're dealing with your retirement. Like, you're going to need to have that interaction. So I don't see us moving that way. I see technology helping customers make choices, helping customers manage their financial life much easier, and simplifying banking and turning banking from being a utility to more of a catalyst in people's lives.
Okay.
Because banking today is like a utility. I pay my bills, I take money out. I see that changing, but my opinion is I just don't see it moving that far down the continuum.
What I see is, you got to understand, financial services can be a broad context, right? So the one was going from personal banking, but there's other elements as well. And Uber is a great example around disruption to basically outmaneuver around a regulated industry, as well as to provide the value of, crowdsourcing and the shared economy model. So, for example, we're already seeing that disruption coming in, for example, around crowdfunding. Tools like Indiegogo, GoFundMe, et cetera, are finding that where small entrepreneurs, even for personal loans, people are going on that for getting financed as opposed to going traditional lenders, as an example.
Good point. Yeah.
So that is another mechanism as well, where you're starting to see the edges of that coming into the market as well. So I do see it encroaching in that space.
Right.
The question really comes down to, do you want to trust your net worth to these companies going forward? And right now, the answer by and large is no. I think the incumbents have a discrete advantage as it relates to that at this stage of the game.
Right. Something to think about.
I could actually give an example of that Uber type of experience already happening in the lending space, though. So there's a company called Affirm in the States. I think it's a company that's founded by one of the initial co-founders of PayPal. And what they actually do is they empower the retailers to actually provide loans on a mobile and an online platform in real time at the POS. So if you think about what they really set out to do, is they're replacing the traditional kind of the credit card line of credit. So, when customers are actually paying 18%, or 17.99% APR on credit cards, they actually replace that and say, you know what, if you're actually making this loan for the first $100 of your credit limit, then you actually probably have a lower risk than when you're spending last $100 of your credit limit. We're also seeing when, like, the type of decisions around when you're actually using credit, a line of credit, to make a purchase around on a laptop computer versus making purchases using line of credit to make purchases around a TV sound system, they also do lead to very different risk profiles. So we're seeing that type of more kind of on-the-spot, kind of usage-based lending models popping up. And I think the question is, to your point, is around, will there ever be the convergence between that marketplace or crowdfunded-based models where different providers actually compete for these type of lending opportunities? And when they converge with this kind of POS type of on-the-spot lending model, if those two things come together, and I think that's what, Mirza, you're referring to as kind of that Uber type of banking.
Right. Interesting. Let's see your next slide. That's a doozy as well. The benefits of scale. So how about we let you explain that one?
Yeah. So what's also really interesting is while including us, a lot of people talk about innovation in financial services. When we talk about innovation in financial services, we tend to talk about innovation that are consumer facing. But what was really stark and evident and surprising in our research was about half of the innovators that are emerging in financial services, or the ones that are calling themselves fintechs, are actually the ones they're set out to solve the needs of financial institutions, not the needs of consumers. And generally, these guys don't get a lot of market attention because media coverage is limited. Also, on purpose, a lot of them actually operate on more of a stealth mode. But what we also witness, though, is these are the ones that are growing at the fastest rate and also getting the most amount of funding from some of the big players, big investors in the market, like whether it's BlackRock or Goldman Sachs or Google Ventures. So as these type of new providers come on to solve for financial services needs, what they really do is they provide financial institutions very economical access to very sophisticated capabilities that are probably not attainable by financial institutions by themselves, especially for the ones that are not big enough. So now all of a sudden, all these small or new or medium-sized financial institutions can gain access to very sophisticated capabilities that are not attainable by themselves before, also without heavy upfront investment. So kind of turning into more of usage-based kind of pricing models. And I think we're seeing this type of kind of democratization of financial services infrastructure and capabilities, spanning across technologies, processes, also access to information, as well as access to consumers, so the distribution channels across these online marketplaces. So as all these innovators that solve for financial institutions' needs kind of take away that benefits of scale, we may actually see a very different competitive dynamics in the future, where we may actually see financial institutions popping up that are traditional banks, but are more focused on niche customer segments and their entire end-to-end customer life cycle. Or we may actually see more kind of credit unions or location-based, or we may actually see more demographics-based financial institutions emerging, and be able to operate and compete effectively without the scale.
So as David mentioned earlier, in terms of fintechs, for banks, then they already are embracing these fintechs behind the scenes, as you've mentioned. So it all comes down to really what can these players do to be part of this regulated ecosystem, it seems then. Before we launch into Q&A, I think now is a good time to switch over to Paul. Paul Frank is the GM and VP of DMTI Spatial. So I'll just give Paul a few minutes to really explain how DMTI fits in the Canadian banking scene. We do a lot of stuff that you guys probably aren't already aware of behind the scenes.
Great. Well, we shared a bit of the insight on the call, but we're real excited to help co-sponsor this webinar today with Financial Operations Magazine and like David and Hwan. So this is just part of our effort to help educate around digital disruption within the industry. And we wanted to provide a few minutes just around where we're seeing specific areas, particularly around our expertise on location intelligence and how that's accelerating the pace of change within the business. And so just by way of extra context, we help companies manage these trends by turning location intelligence into actionable results. And we've been doing this for more than 20 years as the gold standard in high precision data quality for Canada. And if you haven't heard of us, it's okay, but you probably use us every day, whether it's using common applications through Apple, Google, TomTom, for example, to navigate and geolocate, to, in this particular industry, 8 of the top 10 top financial institutions use us in some way, shape, or form to empower their back or front office workflows around customer acquisition or risk management. So it includes, for example, if you're getting a mortgage, you may not know this, but 100% of secured mortgages in Canada get their addresses validated through our systems. And whether it's also applying for an insurance policy or claim, 10 of the top 13 property and casualty insurers use us to help with that. Some of these customers are helping to basically provide real-time offers within seconds to provide as location as a validation tool around risk and customer opportunity, or even credit cards. So customers are using our visualization tools and data to pinpoint risk and opportunity to within meters, greatly reducing overall processing time. They're using our web services to drive mission-critical real-time workflows or customer interactions. And more fintech companies are reaching out to us to build our web services to help embed in their applications. So what that gives us as relates to insight is that the difference today really is around the speed of the way information, particularly location-based, is being integrated to drive top and bottom line results within your industry. And as we talked about, that's leading to significant investments such as B&I analytics, mobile app, risk portfolio management, client segmentation, and even new products. So as large fintech companies, for example, are trying to unlock their data and becoming more customer-centric for omni-channel, I mean, the key here is to have high confidence in your underlying data and to trust it in a more connected world. So a couple examples include being able to geocode your book of business for deeper analytics and accuracy and match rates. But then also you can provide unique identifiers to keep proprietary data secure while you're sharing that within your larger ecosystem. And the partners within those ecosystems, maybe your partners today, but they could also be your competitors. So it's more and more to keep it secure. Google was a great example of that in the insurance industry. And so likewise, as customers are becoming more digital and mobile, reverse geocoding and pinpointing their accuracy is having more accurate and localized service. So just a couple examples I'll highlight that we haven't fully talked about is the maturity of data ecosystems, for example, are becoming more real time. Great example is in the mortgage adjudication process. As you're dealing with multiple parties, you're now able to fill that process now measured in seconds around risk and opportunity and customer qualification, for example, to connect between the lender, the appraisal, the land registers, et cetera. Similarly, around self-service lending, online self-service, not only credit bureau matching, but also connecting to third parties for greater insights on the individual and potentially qualifying larger share of wallet to be able to drive better next best actions. So I'm not just applying for a credit card, I can drive more bundled packages within that environment. And then similarly, Internet of Things, we didn't really touch it, but that's changing the way that banks are looking at connecting legacy data systems outside of that. So for example, in insurance, products like Nest around home usage, whatnot, providing better insight around risk or opportunity management. My fridge is breaking down. I may need a micro loan to buy a new one, to the point of, obviously, what's the exposure in the market, to telematics. A large carrier in the market just came out with a new pay per mile insurance policy to connect within the shared economy, obviously more geared to more the millennial market, which is a very interesting demographic. But that's where, for example, product offerings are starting to differentiate in the market as well, and where location and machine-to-machine learning can come into play from that standpoint. And then likewise, what we're seeing as well is that border between a physical retail presence and virtual banking. So a great example is around omni-channel, but payment processors, for example, are using location to pinpoint where that individual is. And then they can provide a boundary or a geofence around that to not just handle the process, but then you can tie that to more sophisticated loyalty programs and target that at the point of interaction at value, or even bundling that with media and advertising to get and expand the amount of transaction and success rate within that. Similarly, banks with branches are looking to guide digital experience with in-store experience, and how do the mobile app and in-branch experience potentially continue to mesh so you can get more loyalty within that environment. So those are just examples. And then similarly on the risk, with the velocity of the business that's increasing, you're also seeing the propensity to incur more risk. So if I'm going, for example, into the market, am I overly or under concentrating in risk in a market? So for example, in a condo. So if I'm looking at deposits, I want 100% saturation. But if I'm doing secured lending, do I want full saturation if that condo goes down? So there's ways that velocity can add risk into the market where location intelligence can greatly benefit. So the thing that I'd highlight is, as these generally are transformational projects that in many cases can be measured in years in terms of deployment, this could lend to a quick win to provide underlying data quality, to provide basically quicker ROI in these projects. And so we'd love to be able to talk to people if they're interested and provide our coordinates, and potentially there's some more online resources if people are more interested. So I'll put it back to you for closing and final questions.
Great, thank you, Paul. David, this is a question that's come in, something close to your heart. How will this all this digital transformation that we're talking of, this digital disruption, the frontline tellers, the agents, what can be done to help them? Right, they're at the front lines. They get the good, bad, and ugly on a day-to-day. Right, I'm having a bad day. I'm just gonna give my money. You can take it out on the teller almost. If I'm having a great day, hey, Pam, nice to see you. How's things going on at the bank? They're at times your best friends. They're at times a sleeve you can cry on. What can we do for the agents?
Yeah. So what we are working on, what we want to be able to do for the agents is to provide them a complete picture of where that customer's been. So we don't want the customer to repeat what they have to say. We should already know when the customer wants to make an interaction, where have they been, where they're on the website, did they drop off the website, where they're through social media. We should know right away what their problem is. So being able to provide the agent with that information upfront so that the customer doesn't repeat themselves, whether it's an inquiry or whether it's a regular customer service problem, and providing the associate with clear tools to resolve that issue very, very quickly is how we're going to be able to help the agents. So what you need to do is, and this is the one thing that I see banks do, you get a fantastic, beautiful online experience. You call the contact center, it doesn't even mirror it. The contact center didn't know a piece of mail went out. They don't have the information, have to call down to operations and get the information from operations. So the online experience should mirror it, whether it's your face-to-face or whatever customer interaction you have with your clients, it should be able to mirror. And that's how you create that seamless interaction with the client, and that's how you're going to be able to help the agents.
Right, so it could almost come down to a point of internal communications throughout the department to best arm your frontline personnel.
I'm saying even take it even farther. On the desktop, provide them with the information so it's at their fingertips.
Okay, great. So we've now reached the 11:30 mark. I want to once again thank everyone who's joined us for today's session, and thanks to our presenters, Hwan from Monitor Deloitte, David from Tangerine Bank, and Paul from DMTI.
Thank you.
So this is Mirza. Once again, thank you all for joining. We will have a follow-up email with the recording of the webinar, and for your colleagues and peers who missed the webinar, we'll send them an email as well. Signing off. Bye for now. Cheers.